February 1st, 2025, a date that will be remembered for its seismic impact on the global financial landscape. A day etched in the memories of investors as global markets shuddered, flashing crimson red. The financial world was thrown into chaos as stock prices plummeted, and the air was thick with uncertainty. The culprit? Tariffs. President Trump's decision to slap a 25% import tax on goods from Canada and Mexico, alongside a 10% levy on Chinese products, sent shockwaves across the financial landscape. These tariffs were intended to protect domestic industries but had far-reaching consequences. Investors and traders were caught off guard, scrambling to make sense of the new economic reality. The sudden imposition of tariffs disrupted supply chains and increased costs for businesses, leading to widespread panic. Stocks tumbled, with the Dow Jones Industrial Average plummeting by 800 points, wiping out billions in wealth. The ripple effects were felt across all sectors, from technology to manufacturing, as companies grappled with the new financial landscape. Oil, a barometer of global economic health, spiked to $120 a barrel, its highest in years. The surge in oil prices added to the economic strain, affecting everything from transportation costs to consumer goods prices. The tremors were felt far and wide, from the bustling trading floors of Wall Street to the quiet anxieties of Main Street America. Families and small businesses braced for the impact, worried about their financial futures. Where the specter of rising prices loomed large, everyday essentials became more expensive and the cost of living surged, putting additional pressure on households already struggling to make ends meet. The market's reaction was a stark reminder of the interconnectedness of the global economy and the far-reaching consequences of policy decisions. Tariffs, in their simplest form, are taxes levied on goods imported from other countries. Imagine them as border walls for products, making them more expensive for consumers. The stated aim of these taxes? To protect domestic industries from foreign competition, safeguarding jobs, and boosting local production. President Trump, a vocal advocate for protectionist policies, argued that these tariffs were crucial to reviving American manufacturing and bringing back jobs that had been lost to overseas competitors. However, like a house of cards built on shaky ground, the logic behind tariffs crumbles under the weight of unintended consequences. The immediate and most palpable impact of tariffs is felt in the wallets of everyday Americans. Higher prices for imported goods, from Mexican avocados to Canadian lumber, ripple outwards, squeezing household budgets and fueling inflation. But the pain doesn't end there. Tariffs disrupt intricate supply chains, the lifeblood of global commerce. Businesses relying on components or raw materials from targeted countries face delays, shortages, and mounting costs. This perfect storm of rising expenses and supply chain chaos forces businesses to make tough choices, often resulting in job losses. The automotive industry, a cornerstone of the American economy, stands particularly vulnerable to the fallout from tariffs. This sector, which employs millions of Americans, relies heavily on a complex supply chain that spans across borders. With parts sourced from across North America, tariffs translate directly into higher production costs. These increased costs are not absorbed by the manufacturers, but are instead passed down the line, ultimately reaching the consumer. Experts predict a price hike of up to $3,000 for new vehicles, potentially driving consumers away from dealerships and further hurting the auto sector. This price increase could lead to a significant drop in sales, affecting not just the manufacturers, but also the dealerships and the numerous small businesses that support the industry. Energy, another critical sector, is not spared either. The energy sector, which includes oil, gas, and renewable energy sources, is deeply interconnected with global markets. Tariffs on Canadian oil imports translate into higher prices at the pump, hitting American drivers hard, particularly in the Midwest, which heavily relies on Canadian crude. Higher fuel prices not only affect individual consumers but also have a ripple effect on the broader economy, increasing transportation costs for goods and services. The agricultural sector, already grappling with its own set of challenges, faces yet another blow. Farmers, who are the backbone of rural America, are seeing their profit margins shrink as the cost of imported agricultural inputs rises. Mexico, a major supplier of fruits, vegetables, and other agricultural products, sees its exports to the U.S. dwindle, impacting both American consumers and Mexican farmers. The reduced supply of these essential goods leads to higher prices in American grocery stores, making it more difficult for families to afford fresh produce. This interconnected web of economic activities highlights the far-reaching consequences of tariffs, affecting not just industries, but everyday lives. Section 5. Global Backlash, Retaliation and Ripples. Tariffs, much like a pebble thrown into a pond, create ripples that extend far beyond their intended target. Trading partners, faced with what they perceive as unfair trade practices, are quick to retaliate with tariffs of their own. Canada, Mexico, and China, each wielding economic clout, respond in kind, targeting American goods ranging from agricultural products to manufactured goods. This tit-for-tat exchange, reminiscent of the trade wars of the past, does little to resolve underlying trade imbalances and instead fuels a vicious cycle of protectionism, harming all parties involved. Section 6. History's Warning. The Perils of Protectionism. History, often a harsh but insightful teacher, offers a cautionary tale about the pitfalls of protectionism. By examining the past, we can glean valuable lessons that remain relevant today. Protectionism, the economic policy of restricting imports from other countries through methods such as tariffs and quotas, has been a recurring theme in global history. While it may seem like a viable strategy to safeguard domestic industries and jobs, the long-term consequences often tell a different story. The Smoot-Hawley Tariff Act of 1930, often cited as a catalyst for the Great Depression, stands as a stark reminder of the devastating consequences of protectionist policies. This act, which raised U.S. tariffs on over 20,000 imported goods, was intended to protect American farmers and industries from foreign competition. However, it led to retaliatory tariffs from other nations, causing a sharp decline in international trade. Intended to protect American farmers and industries during a time of economic hardship, the act backfired spectacularly, triggering a global trade war and exacerbating the economic downturn. Farmers, who were supposed to benefit from the tariffs, found themselves unable to sell their surplus produce abroad. Factories closed as international markets dried up and unemployment soared. Tariffs, rather than shielding domestic industries, often stifle innovation, reduce competition, and ultimately harm consumers by limiting choices and driving up prices. When countries impose tariffs, they create an environment where domestic companies have less incentive to innovate or improve their products, knowing that foreign competition is kept at bay. This lack of competition can lead to stagnation and inefficiency. Moreover, consumers bear the brunt of these policies, facing higher prices and fewer choices. The lesson from history is clear. Protectionism, while seemingly beneficial in the short term, often leads to long-term economic harm. Section 7. Expert Verdict. A resounding no to tariffs. Economists, almost universally, view tariffs as a blunt instrument that does more harm than good. They argue that tariffs distort markets, create inefficiencies, and ultimately lead to a less prosperous global economy. Tariffs are a tax on consumers, plain and simple, says Nobel laureate economist Paul Krugman. They raise prices, reduce choices, and do little to protect jobs in the long run. Instead of resorting to tariffs, experts advocate for alternative solutions that address underlying trade imbalances and promote fair competition. Section 8. Beyond tariffs. Seeking sustainable solutions. Free trade agreements, when negotiated fairly, offer a more sustainable path towards a balanced and prosperous global trading system. These agreements, aimed at reducing trade barriers and promoting cooperation, can create new markets for American goods, foster innovation, and ultimately benefit both businesses and consumers. Investing in education, infrastructure, and workforce development is crucial to equipping American workers with the skills they need to compete in a rapidly evolving global economy. Section 9. A call to action towards a freer, fairer trade future. The imposition of tariffs is a short-sighted and ultimately self-defeating approach to trade policy. It's time to move beyond the allure of protectionism and embrace a more nuanced and collaborative approach to global trade. Contact your representatives, make your voice heard, and demand trade policies that prioritize sustainable growth, shared prosperity, and a fairer, more interconnected world. The future of the global economy, and indeed our collective well-being, depends on it.